All right, everybody. It is Wednesday. We are coming to you first. Let us say Happy New Year because days away. Aside from that, for everyone we missed with the Happy Merry Christmas, belated Christmas. Can you do that? I don't know. But we wanted to say welcome to Investment Education Academy. We have some interesting news about IPOs that everybody is going to want to hear. If you're listening to the podcast, turn it up. If you are watching us live, tag a friend. This is going to be information about IPOs that is going to change the game for all of us. And Leon's going to tell you why we picked this topic while I do a little housekeeping.
Yeah, so we all love IPOs, right? And one of the biggest issues with IPOs is that a lot of times we miss the big pop, or we don't get in on the ground floor with IPOs. And there's a reason for that. It's because typically the shares that are sold in the quote unquote IPO, which is the day before the IPO, when they actually raise their money, are sold to the big hedge funds, brokerage firms, not brokerage firms, hedge funds, mutual funds, pension funds, big people with money. And sometimes some individuals that are just generally rich. So we, the little guys, are left out, right? So
also, hold up, wait. It's not just the heavily rich. It's also those people that got into the friends and family round. It's the people that got into the Series A, the Series B, E, D, G, F. So it's also those people too. So
yeah, true. Yes, they're the people. All the well, I guess the difference is those are early investors or early shareholders. The IPO is typically sold, but typically is sold to those bigger names, bigger brands. But yes, it's not just the big people. Also, employees, management staff, like Brent said, friends and family are also in. But we the public are left out typically because those initial shares, what are called primary shares, are either sold to those big boys or issued to the staff. So a perfect example is Airbnb, right? Airbnb literally doubled on its IPO day. It was priced at 68, and it came public at 120, 130 bucks. Like it more than doubled on its IPO, and we missed out on that, right? Because again, the IPO process is the big boys get the first allocation of primary shares. Then on the secondary market, which is when it goes public, the shares start trading on the exchange. That's what we can get in. And by the time we get in, a lot of times the juice is already out of stock. So what's exciting now is the New York Stock Exchange just recently submitted a request to the SEC to amend what's called a direct listing. So direct listings are just what they sound like, right? It's where a company can directly list their shares on an exchange without going through the whole roadshow and going through the big boys of allocating their shares to like the hedge funds. Problem with the direct listing prior to this new ruling was that a company couldn't list primary shares, which is where the money is raised, and they couldn't essentially they couldn't raise money via direct listing. They could just list their shares and allow the public to trade the shares, and then companies can use that as currency. But there was no money actually raised, so you wouldn't see that big pop. You would see like in a typical IPO. So direct listings before companies could do it, but they couldn't raise any money, and they were secondary shares. So the new rule now says that companies can now directly list primary shares, and primary shares are where they actually raise the money. So if you buy, like if company XYZ was to go public tomorrow, and they listed primary shares, we would actually, our money that we invest in the company, we actually be going directly to the company for them to raise money in their IPO. So we'd be directly involved in the IPO. And so, Brent, when you get a chance, you can throw up slide one. Or the only slide, really?
Yeah, and everybody who's listening to the podcast, and for you all who are watching this live, you may have been, become aware that Clubhouse is a pretty big app, is growing in popularity. Well, Investment Education Academy is on Clubhouse. So you all have been making requests to kind of have deeper conversations with Leon and I. So we're going to actually have what we're calling a post wrap up on Clubhouse after we leave the Facebook Live here. And if you listen to the podcast, just know every Wednesday between 9:30 and 10 o'clock, you can find us on Clubhouse. We're also thinking about doing it Sunday nights as well, depending on how the engagement is. If you're on Clubhouse, you can just find me. My name is Brent Simpson. Leon, do you know what your name is on Clubhouse?
Yeah, just Leon Noble.
All right. So look for Brent Simpson, Leon Noble on Clubhouse. You should be able to find us. We're going to do a debrief. It's going to be open discussion. If you'd like to join us on the panel as a moderator, please be patient. If you have questions, take them over to Clubhouse, but you can also, of course, ask us questions here because we are still going to do our lives every Wednesday as we always have.
Yeah. So direct listings. So here's the pulling the slide. So yeah, here we go. So as I said, as it's titled, the new rule allows you to buy IPOs, right? And we all seen these IPOs that make these huge runs that we miss out on, and then we typically buy the shares later, and sometimes we'll see a loss or we'll see a small gain, but we don't see the big gains, right? So this new rule, like I said, is called a direct listing. Now there was a direct listing before, but as I said before, those are shares what are called secondary shares, where there wasn't like a big bidding process. They were just listed on the exchange for the shares to then trade, but they would trade relatively lightly, and they wouldn't see that big pop because the company wasn't actually raising money, wasn't an IPO. They were just using that to list their shares they could use for currency, or for many other reasons that companies go public. And the shares are sold directly to the public. So in an IPO, if a company's IPO price is $60, we can buy that IPO at $60. We don't have to wait for the 30-40% jump before we can get in. We can get in at the actual IPO price. And with these direct listings, there are no underwriters. So the reason the no underwriting thing is important is because it's very expensive for these companies to go public, because they have to pay the underwriters like Goldman Sachs, Morgan Stanley, a lot of fees to process a lot of what goes on with an IPO, as well as do what's called the quote unquote the road show, where the company, the underwriters line up all these big boys, all the hedge funds and pension funds, for the company to pitch their shares to the day before the actual listing of the shares. So there's a lot that goes on behind the scenes before that actual IPO day, and underwriters take care of a lot of that. But with the direct listing, all that goes away. The company no longer has to go through an underwriter, and they can delist the shares themselves directly, which will be a huge windfall for us as investors, because one, we can now play in IPOs, and two, a lot more companies will come public, because a lot of companies don't have the money to pay these underwriters their fees to take them public. So doing it directly now, there'll be more opportunity for us to get into buy into more companies.
Yeah, and also for anybody who's thinking, well, it's already rigged, it's already set against us. This kind of puts it back in our court to say, are we going to get in? Are you going to take advantage of this new rule? And this is probably the first place you've ever heard about it. And now the question is, how do you do it, right? How do you buy it? So is there a particular process, Leon? Because I'm not that familiar with this process myself.
Yeah, so it'll eventually get to the point where you'll be able to go to your broker, like Robinhood, Cash App, whomever, Interactive Brokers, TD Ameritrade, and you'll be able to basically get an allocation of shares prior to the IPO. So if the IPO price is $68 or $70, you'll be able to go in there and say, okay, you want to buy X amount of shares, again, a limit order. Say you want to buy, 5 shares, 10 shares at $68, and then you'll be able to get in on that IPO. So you'll buy it. You'll buy it just like any other company, any other shares that you buy, but you'll be able to do it prior to the company going public, and we'll be able to get in on the IPO, the actual IPO price. So if there is a pop,
just be the IPO?
Huh?
Wouldn't that just be the IPO price?
Yes, I'm saying we'll be able to buy the IPO price. Yes.
Okay. So
Yeah.
I wonder how this is going to affect companies, whether they still have that run, or if this kind of eases that run that they normally get after they go into the primary marketplace.
So the thinking behind that is that, so the reason we see those big pops in IPOs is because it's a mispricing by the underwriter. The underwriter sells the shares to these big companies, but the problem is there's only a handful of those big companies, right? There are only a certain amount of hedge funds, and this is it's a whole big buddy network, right? So they bring in all their friends and their boys and their family and allocate them shares, but it's only a select group, right? So only these people are only going to bid the shares up so much. When those shares are then offered to the public, well, not the public, when those shares are then offered to like market makers and other bigger firms that were not allocated during the IPO the day before, which is called price discovery the day of the listing, it's a lot bigger pool. So those shares actually, so the price is $100 a day before the IPO when they actually raise the money. The day of the listing, they're offering their shares to a bigger audience. They're still big boys, but a bigger audience of big boys, and there's a lot more demand. So the price then goes up. It happened to Airbnb, it listed at 68, and they actually hit the market at like 120. So to answer your question, Brent, what they think is going to happen is that since shares are now going to be issued to basically the world, all essentially at one time, we're not going to see those huge pops because there's going to be such a balance between buyers and sellers. There's not going to be this pent up demand because everyone's going to be able to go to their phone and say, hey, get me 5, 10, 20, 100 shares. And the system will balance everything out and it'll kind of come to a fair price. So we may not, we don't know. We don't know. We may not see the pops we saw before if a company does a direct listing, or we may. We don't know till it happens. But the theory is that the pops won't be as big because it'd be such a big pool of investors able to get in and it'll actually get the market price.
This is becoming a huge disruptor for traditional underwriters, because between this and SPACs, I mean, you have these companies that are circumventing a lot of the traditional auditing procedures, which is important for us as investors. And you all should know this: when companies go direct or they go through a SPAC, they don't go through the same auditing process they would if they were going through a traditional IPO. So most companies historically would do direct listings because they were trying to create liquidity for their either people who were holding the stock and it was tied up, or those who were trying to avoid basically giving them a raise or increasing their salary. So they thought, let's add some liquidity to the market by allowing them to trade stock by going direct. And this was Palantir, I believe. Palantir did.
Palantir, I think, did a direct listing. Yeah.
Yeah, and they said it. I mean, they literally said we didn't want to pay our employees more money, so we wanted to create liquidity for them. And a lot of companies do that, but what it does, it gives them the ability to negotiate the prices before they hit the open market. Well, kind of theoretically before they hit the open market. So I'm wondering really how that's going to affect traditional IPOs, like, because they said SPACs has already hurt the underwriters, the big JP Morgans of the world. So this would be interesting.
Yeah, a lot of people are thinking that the traditional IPO is going to go. I mean, some people say it'll go away totally, because the theory is so on average, companies pay 7% of the IPO. They pay 7% of the money they're raising to the underwriter. And so what they're saying now is, okay, if a company can avoid paying that 7% via traditional IPO, why wouldn't everyone just go direct, do a direct listing? So they're saying, some people are saying that we might see the traditional IPO way way of going public go away, because it's such a huge savings for companies now to not have to pay that roughly 7% to the underwriter. So we'll see. I mean, if it does, it's a huge amount of business going away for underwriters like Goldman Sachs, Morgan Stanley. But again, it's all about us as investors. And for us, it's great, because as we covered a couple of weeks ago, SPACs are a way now that companies are coming public, circumventing the traditional IPO. It can be a little more expensive, but there are a lot of different aspects to SPACs that are really friendly to the company and the initial investors. But SPACs are easy, right? The company just merges with another company and now they're public. So between SPACs and direct listings, now we're going to have a huge windfall of more companies coming public in the next, in the coming years. But Brent, quickly, your point on due diligence. So I know with direct listings, so yes, underwriters do quite a bit of due diligence, but they're saying now, what I read was that there's still going to be a level of due diligence the company has. Well, the companies have to provide the SEC a certain level of reporting and a certain level of fact finding on their own to say, hey, we're a legit company, and we're not fraudulent, so to speak. So the whole due diligence thing doesn't go away with direct listings. It just may be a bit watered down, but there'll still be some level of due diligence done to these companies.
Yeah, but it won't be as much as it is now. So this goes back to everybody who's watching this. That's the reason you need to do your due diligence when you're looking at these companies. Don't trade on the hype. Don't just hear rumors and say, you know what, I'm going to buy it. Do your research. Look at the financials. Look at the leadership. Look at their products. Do a 5-year chart. I mean, do some chart. Look at the charts. I mean, spend some time with the fundamentals of the company and decide if it fits your investing strategy, if it fits your risk tolerance level, and always make sure you're investing a particular kind of money, Leon. We haven't done it in a while.
Risk capital, yeah. I almost forgot.
Yeah, no, it's been a while. I mean, that or just use curious money. So wherever you are, these rules are changing. Like I said, we're going to talk about this in much greater detail. Just have an open conversation on Clubhouse. You can find me, Brent Simpson, or search Leon Noble. You can find either one of us in about 15 minutes on the platform. So Let me see if there's any questions for today. Let me take a look.
Yeah, just last point on direct listings. Yes, Brent said, yeah, do your due diligence, because I mean, it's good for us as investors that we're gonna have a lot more companies to choose from, but just because there's a lot more companies doesn't mean they're quality companies. So this is gonna be coming upon us even more to do our research and to do our own due diligence, because you're gonna have so many more options. You know, the new shiny toy in the room, everything's gonna look so great. You can get in on these IPOs. But as we said before, the podcast we did a couple weeks ago, IPOs typically, on average, are bad investments. Yes, we can get some of the pops, some of the Airbnbs of the world, but a lot of us missed out on that because we weren't involved with the IPO. So with all these new companies coming public via direct listing and SPACs, definitely do your research.
Yeah, and Airbnb still what? They I think they went over 300 a share, right?
No. Airbnb was in the ones. I think it was like one mid ones.
No, I mean now.
Yeah, I don't think it's that high. Maybe I haven't been tracking that closely, but I don't believe it is. If it is, that surprised me.
Let me take a look. It might be high too.
Because it came out at 160s, 120s, something. It was, I know the IPO price doubled the day it came out, so it should be.
Or no, it's back. Yeah, no, it went up to 152.
Okay.
Let's see, its highest has been 163. It's trading at 148 right now.
Okay, so it's above. I believe it's above its IPO price, but not by too much.
Yeah, I predict by the end. I say about summer of this year, it's going to be above 200.
Oh yeah, I can see that. Yeah, especially as the economy starts to pick back up next year.
Yep. So we owe him some picks, Leon.
Yeah. So we want to mirror you.
I'll go first.
All right.
Just because I'm already looking things up.
All right. What you got?
So my pick today is one we all know, IBM. Keeping it simple, it's an American company. They actually have a dividend payout on this particular stock of 5.24%. Oh, I didn't do a screen share. Let me do a screen share. Oh, and Phaedra, you asked the question, are you only able to buy SPACs at particular brokerage houses? My response is I don't know. And the reason is,
No, I know.
But
so a SPAC, a SPAC is twofold, right? So a SPAC is, so there's a company that goes public first, which is the acquisition company, and that company will just trade. It'll just trade. But then once, so you can buy that. So the SPAC will come out and you can buy that SPAC. It won't have merged with the company yet. It'll just be out there trading, looking for a company to buy. So you can buy it then, or you can wait till it merges. Once it merges, it'll then change its name, change its ticker symbol to whatever the company is buying. So you can buy a SPAC. A SPAC is no different than any other company. It's just all the SPAC is the way it came public. But once it's public, you buy like any other company.
But
so yeah, you can buy a SPAC. No. A SPAC is just a public company. Like I said, the SPAC, the special acquisition companies. Yeah, I forget that. Yeah, but the only thing it's a process for the way the company goes public. It has nothing to do with the company once it's public. So SPACs is just an easier way for companies to go public. Once it's public, that's when you can buy it. And yeah, you can buy it at any brokerage.
But she tried to purchase it at Merrill Lynch and they wouldn't let her.
Which company?
I'm not sure which SPAC it is. If you want to tell us which SPAC it was, maybe we can get some insight. But also, like Leon said, the SPAC itself is just a regular company. The only thing is it's a shell company, right? That's why they call it what is it, blank check companies.
Blank check, yeah.
You can buy it. The only way I can see it having an issue, depending on the brokerage firms, some of the more traditional firms, maybe there's an issue. I can't see it being one because it's still a company. And they literally, what Leon said, they just switch the name, put the company first, because they go IPO themselves, and then they take that money, and then they go acquire whatever company it was they were interested in.
Right.
So, yeah.
If Phaedra, if you can put in or let us know what the ticker symbol is, we can look it up. But I mean, like I said, if they're public, if it's a public company, it can be bought at any brokerage. There's no restriction on a SPAC. It's just a public company like any other.
Yeah, but I was thinking like maybe like OTC sometimes gets a little weird when you try to buy something from.
I mean, but a lot of them that come out are typically are typically like mid caps or small caps. They're not like pink sheets or OTC. So I mean, yeah, that could be a point. That could maybe the one you tried, Phaedra, was really small, a small one, and it wasn't. Maybe the brokers blocked it for whatever reason, but on average, though, typically a SPAC is a SPAC like any other company. It can just be bought, just put in its ticker symbol, and you can purchase it.
Yeah, that's all. Yep. So that'd be interesting. Again, we're about to give you our picks. If you all would like to join us on Clubhouse, feel free to do so. If you all are interested in joining IEA, you can find us at www.ieamembers.com. We've experienced some growth. I know we're going to the end of the year. Some of you all are looking to set your financial goals for next year. We'll be very happy to help you with that. In addition, Leon and I are playing with the idea right now to have a children's education piece added to IEA. We're trying to figure it all out. We know we want to do it. We're trying to figure out how to get it done the most convenient way. So just be on the lookout for that. And let me see. Let me do a screen share to give you my pick. Again.
So you said you were IBM, right?
Yep. All right. So I chose IBM. The ticker symbol is IBM. International Business. What is it? International Business Management.
Nah, business machines. I mean, nobody. It's IBM. Nobody calls it by its whole name anymore.
Yeah, I was trying to make sure I remembered it. And actually, it's on the screen, so I could have just looked it up. But what I really like about IBM is the fact that, number one, you're talking about a company that has market cap of over $100 billion. They're not going anywhere anytime soon. They're paying a dividend of 5.24%. Remember, most bank accounts right now are paying, I'm giving them being generous and saying 0.5%. So, 5.24%, that's kind of awesome. And you're looking at a stock price right now that is $124 per share. Yeah, that's my pick for today.
All right, and my pick is Alibaba.
Oh, really? Hold up. Really?
Mm-hmm.
Did we pick that already?
No.
Okay.
No, sir. Ticker symbol is BABA. And
all right now.
Today it was up 200. I'm sorry, it was up. Closed today at $238.39. It was up almost 1%. Alibaba, for people who don't know, they're basically the Amazon of China. And they're actually, in some ways, they're actually bigger than Amazon because
they're bigger than Amazon.
Yeah, they're big. Yeah, they're bigger. Yeah, right. They're bigger than Amazon.
Alibaba is like the underwriter of Amazon for like a comparative analysis. Most of the goods, a large selection of goods on Amazon. If I had to just guess, I would say over 30% of the goods on Amazon are actually goods that come through Alibaba and they're resold on. It's probably higher than that, but at least 30%, I would say.
Yeah, no, I mean, yeah, because I was going to say that it's like Amazon and the people in China and here use Alibaba to buy goods for themselves. But as Brent just said, companies use Alibaba to buy products in bulk. So they're almost like twofold. That's how they kind of double up Amazon. And they have a retail side, then they have a wholesale business side too. So I mean they're massive. I think they're the world's largest retailer, wholesaler on the planet. A few stats on them: their revenue average, the revenue growth over the last 3 years averaged 55%, and their profit growth over the last 3 years is averaging 47%. So as I always say, growth companies typically grow their revenues, grow their profits at about 20-25% per year. Alibaba is more than double that. So it's a great growth company, tech company, as well as great growth retail company. And then international exposure, because again, you get the China thing. Actually, you get almost every country on the planet, because every place on the planet uses Alibaba to buy wholesale. Yeah. So you get a huge international exposure with Alibaba.
And also too, Alibaba is their goods as well they fund a lot of the things sold on Mercado Libre. And for those of you all who follow us, you will know Mercado Libre was one of our picks early last year. They're like the Latin American Amazon, but Alibaba is like the grandfather of them all. So yeah.
Yep.
So again, for anybody who wants to join the conversation with us, we're about to jump over to Clubhouse and have some fun with our banter over there. and see if we can fill up a room. So
Right.
we look forward to seeing you all in the new year. We are so thrilled that you all have been with us. I think it's only right that, before we go, we let you all know we're talking about getting over 20,000 views last year. And that is only because of you all. Membership is pushing 90 members now. We're pretty sure we're going to break 100 this year. And this is probably the first quarter of this year. And it looks like our presence on different social media and also media, some media outlets like magazines have picked us up and Amazon's picked us up. All these things are because of you all. We're starting to get viewership in Germany, Belgium, Spain, Canada's real big. So US, of course, is our top market. And all these things are because you all are listening to the podcast. You are supporting us on this Facebook Lives. Somebody bought like 3 gifts of IEA membership for Christmas. So, I mean, these things are all really appreciated. We want to make sure we continue giving you all our best content. And just because we're going over to this new platform to debrief, we will still show up every Wednesday here to talk to you all about what's going on in the market. We're here to answer your questions. Feel free to continue to bring your questions here. 2021 is going to be an amazing year in the market. There's a transition team is in place. So with the presidency changeover, you still see the market may respond some way. I don't think it's going to be a big move because it's already pretty much worked into the market, but you might see a little instability for a small period of time. And there are some things governmentally speaking for funding between government relief, PPP funding, EIDL. Won't go into that, but that does affect the markets because it puts us into further debt. So yes, everybody, thank you so much. Please find us over on Clubhouse. You can look for Brent Simpson or Leon Noble, and we will be happy to answer any questions you have. Have a great day.